Good evening, everyone. Thank you very much for taking the time to log on to this evening's webinar, which is on how to retire early. For those of you that don't know me, my name is Nick Charalambous, and I'm the Managing Director of Alpha Wealth. I'm joined by two of my colleagues today, Clean O'Donoghue and Keenan Cunningham. I'm just going to start the webinar there in the next few seconds, but just before we do that, I just wanted to throw up a poll just following today's budget. And obviously it was a budget, I suppose, that was there to help most of us. So just while you're waiting, if you wanted to just answer maybe the question that we threw up in terms of, I suppose, what you feel that you got most benefit from in some of the giveaways that were provided today. As I said, for those of you that have just joined, I'll start the webinar there in the next 10 or so seconds. But if you want to just click on to the poll, and obviously just provide your responses. I can see quite a few people are already saying about the higher threshold rate for income tax, which has increased to 40,000 euros, which basically will save someone earning over 40,000 euros about 815 euros a year. So I think that's actually one that was very good, especially if you're in a couple that are both earning over that figure. So I just get started, just to say, basically, I'm going to go through a few areas this evening, helping you to understand about how you can become what I call financially independent, and really showing you the best and easiest route to get to that. I'm going to talk a little bit around the budget in brief detail, and if anyone would like to ask any questions, please do free to do so in the chat function. My colleague Cleaner will ask a few questions, and I'll answer them later on, of ones that we've picked up over the course of the last few days. Just to quickly start off with, Alpha Wealth are a progressive financial services company. We started the business 9 years ago. We're Cork-centric. We have an office in Little Island, but we are reaching out to all parts of Ireland. We cover a lot of reviews via Zoom these days, and also in person, but that applies to many different parts of the country. I travel from near and far, basically, for client reviews. So just to kick onto it, the 6 takeaways I wanted to run through this evening were basically helping you understand what your financial goals are and really get a better assessment about helping you to achieve those. In terms of pensions, and pensions, I suppose, are not the only vehicle for people to reach financial independence, but I think they are a very useful one. I just want to get you to see and understand how you can use your pension fund effectively. There is another tax scheme. It's a 5-year government scheme, which I'm going to talk through briefly to those of you that are not familiar with it. It's called the EIS scheme, and explain to you how that might suit you and act as a complement to your pension. In relation to protecting your most important asset, this is providing you with, I suppose, information around how you can insure yourself in relation to what you're going to earn over the next number of years. And then lastly, how you can fund all of this, basically bring it all together. So just to go into it, essentially, I deal with many different types of individuals who all have various different financial requirements, whether they be to save for their children's education, whether it's to become financially independent, whether it's to pay off debt. And really the starting point, I always say to them, is that you need to have a roadmap, and this is where Alpha Wealth can help you. And importantly, make sure that you have a good assessment of where your money is being spent in terms of what you earn and obviously what you spend your money on. There's actually a really good tax calculator through taxback.com, and my colleague Keenan's going to put it into the chat for anyone who does want to look at how the impact of today's budget may have affected them. It's a really good link. It's completely free. It's very user friendly. It's the best one I've come across, and I was looking extensively at quite a few of them today. And I do think it's worthwhile, obviously, just in terms of seeing how your situation may be affected. In respect of how we operate and work, I help people save money. That's my, I suppose, starting point. And people often ask me, you know, how can you help me save? And there's many different areas. You know, I was speaking to clients earlier today who felt that they were in a really good financial position. And what I was trying to explain to them is that it's about helping them get to an even better point. seeing where they were spending their money, and there were a few areas that they were a little bit loose on, you know, in terms of, say, protection policies that they'd accumulated over the course of years, some of which weren't as necessary, and I think they accepted the fact that their money could have been better spent elsewhere. In relation to pension funding, whilst they were part of a company pension scheme, they didn't realize that they had a lot more opportunity to accelerate their pensions and reach that level of financial independence. But the key thing really is that for all of us, I feel very strongly that we should be looking to save at least 10% of our income. And again, please feel free to go onto our website. We have a free budget calculator. It's a really useful tool that I would suggest that you'd use at least once a year, just to kind of get a sense of exactly where you are and how we can help you navigate that. There's no obligation to dealing with us, but I'm going to talk a little bit later about how we can assist you and how easy we make the process. Okay, so to get into the nub of it, what do you need in a pension fund? How can you become financially independent? And there's really three numbers that I'd like you to focus on. The first of which is 400,000, the second is 800,000, and the last one may seem like an extraordinarily large number, but it is a number that some people do achieve, and it's a figure of 2.15 million in their pension scheme. It's the maximum amount that anyone in Ireland can actually achieve. So just to talk about, okay, these thresholds and how to get you to understand about the significance of them. Whether you are starting out on a pension scheme, whether you have a pension scheme, whether you're in your 50s or whether you're in your 30s, it's not to sort of guilt you and say, well, you should have a pension scheme of 400,000. It's trying to help you bridge the gap and perhaps achieve a higher hurdle rate, insofar as it's no point talking about, you know, the past and, you know, not having made contributions previously or not understanding pensions. The main point I suppose I want to try and get across today is that if you reach a point, let's say it's 60 or 65 years of age, and it's not set in stone as to when you need to draw this pension benefit down, and you can do so in different phases. For anyone who has worked in previous employments, you can draw your pension scheme down from 50 years of age onwards. So it's not a case that you have to necessarily wait, and we can help you understand the benefits versus the, I suppose, the cons of doing that. But if you were to achieve a figure of 400,000, and let's say you were 60 years of age, what that would look like in today's terms is that you would achieve 100,000, which is a quarter of it tax-free, and the balance of that money, which is 300,000, you would draw a pension of, which would accumulate to roughly about 24,000 a year. If you take into account the state benefit, which kicks in at 66 years of age, that'll bring you close to the threshold. Now, the threshold today was obviously increased to 40,000 a year, but based on, you know, the natural course of things, especially with a little bit of additional growth, you'll be pretty much bang on that level. And that's the sweet spot really for anyone who's looking to live reasonably comfortably in retirement and not pay too much tax. For those of you that may have the ability to fund more aggressively, especially if you are earning more money or may have built up a pension fund, the next threshold point that I say is 800,000. And the significance of this figure is that if you were to achieve that number, that would allow you to draw the maximum amount tax-free, which is a quarter of which would be 200,000, which is the maximum allowable. And the balance of monies then would give you an income of around 36, close to 40,000 a year, which would pretty much get you to that kind of threshold level. And obviously then potentially have the state pension in addition. And you can manipulate the income that you draw to ensure that you do not pay too much tax. A lot of people don't necessarily understand that when they draw their pension fund down, whether it's at 60 years of age or 63 or 65, and this is where we can help you navigate, which I'm going to show you shortly. The key thing is that you can decide how much income you draw and obviously make sure that you're not overpaying in tax. So if you don't need the income at that time, let's say you're still working part-time or you have another source of income, you try to reduce the amount in the years that you're earning that money, and then obviously you may then increase it. And people often ask me, well, Nick, what happens if I pass away and I don't spend the money? It is an asset and it passes with you. So if you're in a situation with a partner or a spouse, it will go to them. And if it's the fact that they predecease you, it will go to children. So the asset is never lost. The next thing I just want to show you here is that in Alpha Wealth, we get people to understand basically where you are now. So the first question I always say to people is, do you know roughly what your pension scheme is worth at the moment? Sometimes people know, sometimes they don't. And it's just helping them understand that they should kind of have a sense of where they currently find themselves. The second thing then is how much is going into the pension scheme. Is it that you're in a company plan where there's 5% of your income being paid by your employer and say 5% by you? And then a case of then illustrating to you what that might look like and help you understand that if you can marginally try and increase that, particularly through pay rises or through bonuses, that, you know, it'll help you achieve that figure that I spoke about earlier of financial independence. We help people understand about where their investment funds are, because there are choices for many of us, and it's an understanding of the fact that whilst we are in a difficult period at the moment in terms of the way that pension funds have performed over the last 11 months, it doesn't mean that, you know, you shouldn't look at funds and understand where you are on this risk scale of 1 to 7, 1 being cash funds, 7 being high risk. Again, I had a client earlier who said to me that they were kind of concerned about, you know, recessions and, you know, the state of the economy, that they would like to de-risk their pension fund, but they had over 20 years until they were looking to draw down the benefit. And I suppose the point and principle I was trying to give them is that because they were still buying into their pension monthly, it was going to actually help them buying units low at the moment. But more importantly is that they had a lot of time to recover from any pullback. And over a period of 5, 10, 15, 20 years, you know, I felt very strongly that it is absolutely going to overachieve rather than them being in a very secure, no interest earning fund. I see someone has put up a question, and we will address any questions later on. And if you would like to ask any question, please do feel free to do so.
Nick, can I just interrupt for a second? It's just somebody having a problem with sound, but I seem to be able to hear everything perfectly. So sorry for interrupting.
Yeah, that's okay. Thank you. Sorry. Yes, I thank you for pointing out. If anyone is having any problems with sound, please do let me know. But hopefully it's not on this end. Okay, so just in relation to pensions, and I'm not going to sort of preach the gospel, but pensions are very tax efficient. You know, if you think about it, if you're in a situation where you put in 100 euros and the government give you back 40 euros of that every month, if you look at it and spin it around the other way, if I said to you today, you put 60 euros into something and it turns into 100 euros immediately, that's a 66% return. It's really powerful. And the main point I want to suggest to you all this evening is that it's really, really important to make sure that you're benefiting. And there's not many ways that we can benefit and get a tax, I suppose, relief from the government. This is one of the very few vehicles available to pretty much anyone who's working. So I would encourage you to kind of look at this. And again, we don't have any bias in this. Alpha Wealth can help you as an independent broker understand where you are with your pension and understand really where you're going. And it might be a case that you may have an old pension scheme that you don't know where it's at. You may have a foreign pension, I have a UK one, and just getting a better sense of exactly what it is and what it can actually achieve for you. So just to, I suppose, help you understand this, let's say you're a 30-year-old and you're earning 37,000 a year. Sorry, excuse me, take that back a step. You're earning 50,000 euros a year, and you would typically be taking home about 37,000 of that. If you were to make a commitment to pay into a pension scheme, and the gross figure would be 7,500 in this illustration, you would be entitled to 3,000 euros tax back, which is the 40% relief, which would essentially enable you to then build up this pension fund of close to €1 million by the time you reach 65 years of age. And as I illustrated earlier, you'd be entitled to a quarter of it tax-free, which is a limit at 200,000, the balance of which then you pay a very low level of tax, and the remainder you draw as an income. So the point I'm trying to make here is that without taking a huge amount of pain over a long period, you can build up a very generous pension fund for yourself just by starting early and by also getting the benefit of the government's relief. The illustration I've thrown on the screen here is actually for myself. I'm 48 years of age, current pension fund of about 200,000, funding currently about 1,000 euros a month, which is distributed between myself and my company, of which I get 40% relief on my payments. So it costs me 300 euros a month. And for that, I get the benefit of building up this pension by the time I reach 65 years of age, which is the time that I'm looking to reach that age of independence, at 881,000. The one thing to be mindful of is that inflation, and again, we provide these illustrations for all individuals, will pare that figure down to about 629,000. So this is a very simple illustration we do for everyone. But the other thing to note is that we need to do it regularly. So once a year, I always say to people, it's worth checking in, seeing where you're at. Has the fund performed? Have you made any injections of contribution? Have you changed the amount you pay in? Has your salary increased? And then it's just trying to target that as you get closer to that age. One of the opportunities for people at the moment is buying a property through your pension. People may or may not be aware, but that is a possibility still, despite the fact that legislation has been slightly altered earlier this year. It is very possible for people to buy properties in their pensions, particularly from previous employments, or anyone who has a company pension plan of which they are the, I suppose, employer themselves. But let's take an example of someone who works in a pharma company and builds up a fairly decent pension pot of 200,000-300,000 euros. If they leave that company, they can use that fund to purchase an asset like a property. It's just something to bear in mind for anyone who has an interest in investing in property. And the advantages really are that you pay no income tax on the rental income, and you also don't pay any capital gains tax on the profit of that property. But again, that's an area that you need a little bit of guidance on, and it's something that we'd be happy to assist you with. This is around the time of year where financial advisors like Alpha Wealth talk to individuals, PAYE employees, and self-employed people to say to them that you have an opportunity not only to pay into a pension fund and increase your pension to get this 40% relief, but you can actually go back a year. So the example I used earlier for someone who's earning 50,000 a year, and let's say that they're 40 years of age, they have the ability to put 25% of their income into a pension scheme, which is quite a generous amount. But they can also, if they hadn't utilized the maximum for last year, do the same again. So if you happen to be in a position where you have some funds, or you may have come into some funds, you might have sold a property, you may have had a gift or an inheritance, it would be an extremely tax effective mechanism to use, where you could put up to about 25,000 euros as a one-off payment and get an immediate rebate of 10,000 euros from revenue. It's really significant, and it's well worth exploring for anyone who hasn't used up. And the key thing to note is that because you've made that contribution by way of a lump sum, it'll enable you that money to grow tax-free for the period before you draw it down, and typically save about 2 or 3 years off your working life. And again, we can get you to understand that. For anyone who owns their own business, or say works in a smaller company, you have the ability then to make contributions directly by the company. The company benefits from not having to pay employers' PRSI, which is about 11%, but also as an employee or obviously as a director, you can benefit fully from that contribution. So the example on the screen here is someone who says due a bonus of 10,000 euros. If the bonus is paid directly into the pension, doesn't cost the company the extra 11%, so the company saves 1,100 euros. And instead of the employee suffering over 50% tax of that monies, they get full benefit for that. I just want to talk briefly about reducing your tax over a 5-year period. Now, there is a scheme, it's called the Employment Investment Incentive Scheme. And I think it's a really credible investment opportunity for individuals who are suffering tax at the higher rate. So anyone who's earning over 45,000 euros or more, you would typically be paying at least 5,000 euros at the higher rate of tax. If you have 5,000 euros in a bank account, or if you've got the ability to build that money up, let's say this time next year, you'll be in a position where you can invest in this qualifying scheme, where the revenue will give you back 40% of that within 6 months of you making that investment. So basically, you put in 5,000, you get back 2,000. The example on the screen here is for someone who invests 10,000. Obviously, you get 40% of that back within 6 months, which is 4,000 euros. And the point being is that after the period of a minimum of 4, but I'm going to extrapolate this out to 5 years, because that's the maximum period which this typically runs for, you would be due back roughly 12,000 euros, which is a double your money investment. Now, I'm going to talk briefly about two companies which I think are the strongest in this space. One of them is a core company called Blacks of Kinsale. I actually visited the site on Friday. The people you can see on the screen are Sam and Maudlin Black. They're a really impressive couple, fantastic company, valuation currently of 15 million euros. It was set up in 2013, which is phenomenal. The company generated revenue of 2.1 million last year. They're on for revenue of 3 million this year, having made a profit last year of about 675,000. They're raising 5.4 million to develop a site in Kinsale, which is going to basically allow them to distill whiskey, and also it's going to provide a kind of a tourism centre, a little bit like Jameson's in Cork. And it's a really, really impressive site. As I said, I've seen them. They're actually kind of currently digging ground there at the moment, and that'll be ready next year. But this is one, as I say, opportunity for people who are interested in looking at this further. We can provide you more information and prospectus, and obviously, you can talk directly to the company owners, or indeed to ourselves in terms of how and why we feel that this makes sense for someone who is looking to invest. The second company I want to talk about is through a renewable energy fund, through a company called BVP. I was in Cork City today at a presentation that they gave. I've dealt with this company for several years now, and they've been providing this scheme since 2007. And what they do is they select and they cherry pick, and they're very meticulous in the companies that they do select, somewhere between 5 to 9 companies every year that they believe provide an opportunity to make money in the area of environmental social governance, i.e. kind of green tech type environmentally friendly companies. It's really impressive to hear them talk about the philosophy that they use and the mentality in terms of the selection process, and their track record is very, very impressive. And again, if anyone is interested in more information on either Blacks or BVP, we'd happily provide that to you. So I just want to quickly finish off on 2 more things. One is protecting your most important asset. I'm not going to spend too long on this, but the interesting thing is that most of us, our most important asset is our income. For anyone who has, say, 20 years of employment left, who's earning 50,000 euros a year, you're going to earn €1 million over that 20-year period. It's really important to understand that there is an opportunity for you to insure yourself. Some companies do provide a level of income insurance. They may provide it for, say, 3 months, 6 months. But for those companies that don't, or for anyone who is concerned, particularly if you are the only income earner in the household, I just think it's worthwhile checking in and seeing what it would cost you and what it offers you in terms of benefits if you are unable to work through illness, injury, accident, or sickness. So the last thing really I want to say then is everything I've spoken about obviously costs you money, to put money into a pension scheme, to invest in the EIS scheme, and in relation to protecting your income. But the key point I suppose I make to people is that we want to sort of show you how we can save you money and how we can help you to afford these things. And it may be incremental and it may take some time to achieve, but we've helped people over the last 9 years save money in mortgages. We don't provide mortgages in Alpha Wealth, but we provide independent advice to helping you save money. And I say the same thing every time that I do these webinars. You shouldn't be paying more than 2.25% interest in your mortgage, and you should be fixed at this point in time, in my opinion, for at least 4 years from now. It's really important to understand that whilst you might be on a relatively low rate on your mortgage, that you need to make sure that you're not going to come off a fixed rate in the next year or two when rates will be significantly higher, and you're going to find yourself with a very expensive problem at that time. And if anyone would like some guidance on that, we'd be more than happy to help you. The main thing I always say to people is go back to your current bank and ask them about fixing now for a 4 to 5 year period. And again, we can help you understand that. There are certain areas of insurances that I believe people are paying way too much for. Mortgage protection insurance is one of those which you're all forced to take out if you take out a mortgage. House insurance is another one which I think is people spend too much on. They tend to over-insure in many cases, but they certainly don't have necessarily the time to shop around. Car insurance is another one. Loans, I have some clients who are not adequately repaying back their loans. They tend to pay back bits of loans rather than focusing on the most expensive debt. Health insurance is a huge one. For anyone who has either a company health insurance plan that has options, i.e. like a gold, silver or bronze option, and we can help you understand what makes sense for you because you pay BIK on it, so you shouldn't always opt for the best plan. But also, if you're paying for it yourself personally, I think there's a huge cost saving here. For anyone who has children, you typically shouldn't be paying more than one child. I have children myself. I've never paid for more than one of them. And the other thing is to note that you can save money in pensions and saving schemes. Many people have maybe some form of savings. You may be saving through the likes of Irish Life or, you know, Arc Life or Aviva. Not all savings plans are the same. Some savings plans are extremely expensive and some savings plans are in very poor funds. And let us help you understand and show you how you can save money. Typically, we would say to you, you shouldn't be paying any entry fee for your savings plan. You should have the government levy covered, and you shouldn't be paying a management fee typically over 1.35 to 1.6%, depending on whether it's a lump sum or a monthly contribution. But I'd like to suggest that there are definitely some areas there that I think some of you should be able to benefit from by having a conversation with us. The last thing I just want to say briefly is that we're offering a financial review to anyone who's on this call or listening to playback. The normal consultation fee is 199 euros plus VAT. We've held the fee for the month of September, so we have another 3 or 4 days where if anyone would like to book an appointment with myself or one of my colleagues, we are offering that for a 99 euros plus VAT fee, which costs a total of 121.77. And in that, we provide these financial projections that I spoke about on both savings and pensions, helping you save money, helping you reduce the cost of your mortgage, planning for education for kids, and so on. And it's a one-off cost in that it's not just a consultation fee for an hour. This pertains to all follow-on reviews that we do over that period, because it may lead to 2 or 3 conversations, and indeed providing you with the relevant updates and help you understand where you are. And the most important thing is that it's hassle-free. I have a lot of clients who say, oh, Nick, this sounds good, but I don't have the time. The only thing I ever ask for someone is that they give us the opportunity to do it for them. Typically, it's done by way of them signing an authorization where we reach out to the various different product providers. We tabulate the information based on the plans that they have on a spreadsheet, and then we help them understand where we see that there may be some improvements for them. So without further ado, I just want to introduce my colleague, Cliona O'Donoghue. There is our next webinar that I'm doing on Thursday, the 13th of October at 8 p.m. where I'm going to talk specifically about examples of how to reduce the tax that you pay. And I'm going into a little bit more detail than I did this evening. But you will see on the screen there that we are doing several webinars over the course of the next number of weeks. And it is something that I would suggest you might keep an eye out for. And certainly, you know, if you want to follow us on our Instagram page or indeed look at our website, you will get details of these. So, Cliona, I'll introduce you at this stage.
Yeah, thank you, Nick. And I suppose I'd encourage people, if they would like to ask a question, just to pop it into the chat function or the Q&A section just on the bottom of your screen. So the first question is around just today's budget. So can you give us an indication of what effect the budget today has on pensions, if any at all?
There were no changes to pensions, apart from the fact that because of the fact that the, I suppose the threshold for paying tax at the higher rate was increased to 40,000 euros a year. Now, bearing in mind that's not going to take place until the 1st of January. If anyone is in that sort of category of sort of somewhere between 37,000 and 40,000 a year, it's definitely worth considering just checking in on your pension contribution, because you will have been getting relief at 40%, but that will fall back down to 20% from January. So ironically, it actually won't suit those members because the amount of tax relief they receive will actually lessen. Now, hopefully that will, you know, dissipate over time, particularly if you get a pay rise or a bonus. In respect of pensions, there's been no mention of any specific changes at the moment. That may come out in the finance bill, which is generally released a week or two after the budget. And we'll obviously keep in mind to that, and we'll give you information through our website and through our Instagram page if there is anything significant.
So this person has just around a bonus. So I'm due a bonus overtime payment. Can you suggest what the best thing to do is to do with this at the moment? They haven't given any figure, sorry.
Yeah, that's okay. The key thing really is, firstly, it's to assess, I suppose, what are your financial objectives? Because there's no point me saying that you should forgo the bonus and put into your pension, because that is the most tax effective thing to do by far. But if your objectives are that you want to try and buy a house, and obviously you need the money, you're going to have to just suck it up and pay the tax. The key thing about financial planning is it's about balance. Most of what I do really is just helping people, I suppose, see where they are. And most of it is really just fine tuning. So it's about getting you to understand that maybe you're slightly underfunding your pension, or maybe you're overspending on insurances where you can reallocate that money towards savings or towards your pension scheme. So to answer the question, in the main, I would say if you can do without the bonus, put into your pension. But if you need to look at drawing that pension, the bonus down to pay bills or whatever it might be, obviously then again, it's a case of maybe trying to help you assess your financial position to put you in a position where you don't have to rely on the bonus.
So I want to retire at 55. Can you suggest what the best thing for me to do is?
Anyone that wants to retire before 60, they really, really need to focus on building their pension fund up. It is honestly the only way that I can envisage, unless you've been extremely lucky and you were one of these cryptocurrency profiteers back in the day. It isn't easy to try and build money up. And the reason why I'm focused on pensions is that, especially in times like now where, you know, we're seeing some headwinds, there's problems obviously globally. If you think about getting 40% of a break immediately and then benefiting from the growth of that money tax-free for the next 5, 10, 15, 20 years, you won't get anything that equals that. So, as I said, for anyone who does or is interested in looking to retire early, I would suggest that you really do focus on that. And it's not just yourself, it could be your partner as well. Like, again, I spoke to a couple today where one of the partners was, you know, really seriously funding their pension and the other one wasn't. And I was trying to talk to them as a collective and say to them, well, okay, but overall, you're kind of only really doing okay. I need to try and help you kind of try and build up a small bit in terms of where you'll end up, because, you know, you can't treat it in isolation.
So should I be investing my pension in a high or low risk fund?
It really depends on your term to retirement. So for anyone who is in their 40s, like myself, let's say, typically based on a scale of risk from 1, which is cash, which is safe, to 7, which is high risk, like, you know, shares in direct companies, I would suggest that you wouldn't be in either category. You know, it's somewhere a blend in the middle. And again, as you get close to retirement, you start to de-risk. But there is advice needed. And rather than giving you kind of a high level answer, we use an independent analysis tool. Again, it's part of this financial review process that we do, and we help you understand your options within your pension fund. So, you know, for someone, let's say, who has a company pension scheme with Irish Life, there's no point me trying to rubbish Irish Life because you're stuck with them. It's about getting the right fund, the best fund for you within your current position in terms of, as I said, term to retirement and the amount of money you have invested.
The next question is around inheritance. So this person has said, I'm due an inheritance. Would it be best to pay off my mortgage or invest it in my pension?
For anyone who does receive an inheritance, and obviously it depends on where the inheritance comes from and it's dealing with the tax implications that may apply. Typically, you can inherit up to 335,000 from your parents. If it's from a family member who's not a parent, it's typically threshold is around 30,000, and if it's from a stranger, it reduces again down to about 16. Again, as I said earlier, it's about balance. So I would say it's worth exploring all the options, and depending on the amount involved, it might be a case of doing some of all of it. So you might pay a little bit off your mortgage, you might put a bit into the EIS investment option because it's a shorter term tax back scheme. You might invest further into your pension as well, and then obviously you might look at then some medium term savings. The key thing with financial planning, guys, is that I always say this: sure, anything less than 3 years stays in the bank. Medium term, 3 years up to retirement, you should look at other vehicles like the EIS scheme. And there is a really good savings account with Zurich that I speak about extensively. You can get the video on our website where I talk frequently about it. I think it's the best savings plan in Ireland by a mile. And then long term is your pension. And it's just about finding, as I said, the right balance between them.
And is there a maximum that you can top up your pension by in a year?
There is. So there's the age related limits, which I put on the screen earlier, but they are very generous. And as I said, you can go back a year. So for example, somebody who is, let's say, in their 40s, it's 25% of your earnings. And that's not 25% of your basic. The one other thing that a lot of employees forget is that whilst their contributions are based on their basic salary, but these limits are based on their overall earnings. So someone who's saying, oh yeah, Nick, I'm paying 10% of my salary gross into my pension, which is what I think you should be doing, by the way. And I say to them, okay, but that's not 10% of your earnings. That's 10% of your basic. And if you're getting quite a bit in OTE earnings through bonuses, and if you're in any way incentivized, you need to start thinking about maybe putting more into your pension scheme.
This question is relation to somebody who has a pension from an old pension from a previous employment, and they just want some advice around what they should do with that old pension.
I don't like people leaving their old pensions in their previous employments, even if it's a defined benefit scheme, believe it or not. And I can give you some guidance and advice as to why I just said that. But it's about, again, information. Information is key and it's power. So it's about assessing what your options are. You have an option of either moving into your new company or moving into a separate standalone bond, which allows you more control and being able to access it from 50 years of age onwards. But the most important thing is that you're not paying too much in fees and that you know where it's been invested, because there's no point. You could have a really, really good pensions from the previous employment, but if it's invested in a really poor fund, you're going to find yourself losing a lot of money over the next number of years. And that is, I suppose it's unnecessary on the basis of allowing someone to manage it and obviously give you guidance and advice through any advisor you may use, obviously Alpha Wealth, or indeed someone that you may already be using.
There's a question as well that has come in. It's, as a director, my company pays 100% of my pension. Is there a limit on what my company can pay regardless of my salary? For example, I take 50k a year in salary and my company pays 25k into my pension. Is there tax implications on this? And what if company pays 40k a year?
Yeah, thank you for the question, Hugh. The limits are very, very generous for a company. And I should have said earlier that some people get confused that if their company's paying into the pension scheme, it reduces their ability to pay in. It doesn't at all. So those limits that I've got on the screen there, they're the personal limits. Now, for any company owners, they have the ability then to get their companies to pay directly into their pension. And the limits are really generous. On average, it's about 100% of your salary. So the example given there is someone who's earning 50,000 a year. Generally speaking, their company can invest 50,000 a year into their pension. So that's 100,000 a year that you can draw from your company, and you don't pay any tax on 50,000 of that. However, if you've been in that company for several years, you will have the ability typically to put in somewhere up to about, believe it or not, 5 times your salary. So I've seen, and I have some company owners who are funding aggressively, and they're paying in contributions of 250,000 euros on a salary of 50,000, because revenue will give you catch up for the years where you weren't funding your pension sufficiently, which is what most company owners didn't do, because obviously there would have been periods where they couldn't afford to, or they may have had to set up the business and obviously go through a bit of the initial hardship.
And just the last question then is just clarity around, you mentioned about buying a property through your pension. Can you live in this property personally?
No, it's one of the things that buying a pension in your property, the exclusion is that you cannot live there, or you cannot have it rented to a family member. It has to be an arm's length agreement. So whilst it may not seem ideal, obviously, people can't just use their pension funds to buy houses, unfortunately. But you can buy an investment, And obviously, for those people who like the idea of bricks and mortar, using your pension fund, I think is certainly an opportunity. I'm not saying to buy the property. I can't say to you to do that. I don't think now is the best time, by the way. I do believe that property prices have reached their peak. But over the next few years, potentially as property prices start to fall, and people who do like this kind of separate income stream, if you think about it, if you own a property in your pension fund and it's paying rent of say 15,000, 20,000 a year, that's income that you can draw from that pension scheme and pay very little tax on. It really is something for people to consider. And again, there is a little bit of advice needed, and this is where we can help you understand it.
That's everything in relation to the questions. So you can probably wrap it up there. Thanks.
Great, thank you. Just to finish off on the poll, and thank you very much for everyone who has kind of put in their nomination. It seems that the outstanding winner was the higher rate for the threshold before you pay tax of 40,000, which I think I totally agree with. Look, I think the budget was kind of a budget to try and please everyone. There wasn't much in relation to, I suppose, the specific area of pensions, obviously, but it doesn't make them any less, I suppose, valuable. But the key thing I just wanted to finish off on, and thank you again for your time, is that we would encourage you to try and avail of the financial review. I'm not just saying this as a sales gimmick, but the cost will increase to €199 plus VAT from the 1st of October. It is vastly cheaper than many other providers in the marketplace. We've seen some financial advisors charge 500 to €1,000 for the service that we give. So look, I just encourage you, I do think it will be money well spent, that you should consider a financial review and do it at a time and day that suits you. Whether you want to book it for October or November, we'll be happy to carry that through for you. Okay. And I should say, for any existing clients of Alpha Wealth, the fee is €99 plus VAT, and it will remain at that for the foreseeable future. But obviously, we would encourage you, if you are looking for further advice and guidance from us in areas other than what you have with us, the fee applies only in that instance.